Hi everyone, a very warm welcome. My name is Vaishaka Bhat, a practicing CA in Bangalore. I practice in the area of direct tax with specific focus on international tax and transfer pricing. We start with the first module. This module is designed to introduce you to the basic concepts in transfer pricing. So let's get started. Let us understand the concept with a simple example. This will help appreciate the circumstance that necessitates the introduction of regulation and its impact on multinational groups. Here is a group that consists of Company X, which is in Singapore. It has a wholly owned subsidiary, Company Y, in India. Tax rate in Singapore is 17% and tax rate in India is 30%. Company X manufactures certain goods in its factory in Singapore and sells to Company Y for onward sale to customers in India. If you see in the table at the top right corner here, we are given some facts and figures. Cost of manufacturing the product in the Singapore factory for Company X is $1,200. Company Y expects to incur about $100 towards selling cost in India. The product is expected to fetch a selling price of $1,600. Therefore, that makes the expected system profits to be $300. Let us come to the left part of the slide and understand how the parties have arranged their transaction. Company X manufactures the product at a cost of $1,200, adds a profit of $100, and sells to Company Y for $1,300. So, $1,300 becomes the purchase price for Company Y in India. It incurs selling cost of $100, sells the product at $1,600 in the open market, thereby leaving $200 profits in the Indian jurisdiction. Of the total system profits of $300, profit that is left in Singapore is 100 and profit in India is 200. Apply the respective tax rates, that is 17% and 30% in Singapore and India respectively. We have a total tax cost of $77 that the group pays, which is about $17 in Singapore and $60 in India, and brings the effective tax cost of this overall group to 25.6%. Now, a small tweak to this example. In the earlier example, we saw that Company X, which is in Singapore, was selling the products to India at $1,300. So in this example, let's say it sells to Company Y in India at $1,400. What this means is that India buys the product from Singapore at $1,400 and the rest of the facts remain the same. So in the same example where the overall system profits was $300, by just changing the intercompany pricing, the group has now managed to keep $200 in Singapore instead of 100 as in the earlier example and reduce the profitability from $200 to $100 in India. So what does this mean to the tax effect? Let's see the table here. Profit that is left in Singapore is 200 and profit in India is 100. Applying the tax rate of 17% and 30% respectively, the total tax cost has reduced from $77 in the earlier example to $64, thereby bringing the effective tax cost of the group to 21.33%. This is a fairly simple example. It, however, illustrates and gives us an idea as to how two companies within a multinational group, by simply changing the pricing they adopt for transactions entered between themselves, are able to optimize or are able to reduce or change their tax cost or effective tax rate. As can be seen from the example, the multinational companies within the group have so much flexibility to price transactions undertaken among themselves, which could have an impact on the tax base of the respective countries. This necessitates a law to regulate the manner of intercompany pricing between group companies operating from different geographies. That brings us to the next question. What is the importance of transfer pricing? It can be broadly understood as follows. To protect the tax base of a particular country, It also ensures that there is no discrimination between what is permissible and allowed for a multinational group vis-a-vis an independent company. It ensures that there is equitable sharing of tax revenues between nations. In the earlier example, while the overall profit is $300, both the countries, that is India and Singapore, are entitled to their fair share of taxes on such profits. Finally, it also acts as an anti-avoidance measure. The regulations are there to ensure that the group will not use it as an opportunity to derive a tax advantage through the tax arbitrage arising from different tax rates available in different countries. The concept that is a bedrock of transfer pricing provision is called the arm's length price. Arm's length price is a price which is applied or proposed to be applied in a transaction between persons other than associated enterprise in an uncontrolled condition. In simple terms, arm's length price would mean any price that would have been applied between unrelated parties in an uncontrolled condition. Transfer price or transfer pricing is understood as a price entered into by taxpayer with its related party. The term transaction or international transaction has been defined so widely that it could cover any kind of transaction. It could relate to purchase or sale of raw materials, components, finished goods. It could also relate to purchase or sale of capital goods or fixed assets such as plant and machinery, land, building, etc. It covers services, any transaction relating to intangibles, whether it is payment of royalty fee or for use of outright transfer or purchase, is also covered under its ambit. It also covers capital transactions such as share capital related transaction as well as borrowings and guarantees. In our earlier example, the relevant transaction is the purchase of goods and the price paid by the company Y to company X is the transfer price. Transfer pricing as a concept requires the taxpayers to enter into a transaction with related parties at arm's length price. Considering the wide ambit, it will be important to remember that any and every kind of transaction could potentially be considered within the ambit of transfer pricing. Moving forward, let us see what is the legal framework that is available in India so far as the TP provisions are concerned. So, when did it start? The provisions were introduced by the Finance Act 2001. This was when we would have seen increase in cross-border transaction between multinational entities as a result of liberalization of foreign direct investment in India. And the rationale for introducing TP was explained in the explanatory memorandum to Finance Act 2001 as the increasing participation of multinational group in economic activities in the country has given rise to new and complex issues emerging from transactions entered into between two or more enterprises belonging to the same multinational group. The profits derived by such enterprises carrying on business in India can be controlled by the multinational group by manipulating the prices charged and paid in such intra-group transactions, thereby leading to erosion of tax revenues, with a view to provide a statutory framework which can lead to computation of reasonable, fair, and equitable profits and tax in India. In the case of such multinational enterprises, new provisions are proposed to be introduced in the Income Tax Act. Circular 14 was thereafter issued to familiarize the taxpayers under the transfer pricing provisions. So, it is important to understand what the memorandum stated. It said that the objective of the statutory framework was to ensure computation of reasonable, fair, and equitable profits and therefore tax in India. Going back to our example, all that the Indian government is interested in is that the group has made $300 of profits. Then the right amount of profits that is considered fair and equitable has to be offered to tax in India. So we have a set of sections codified under the Income Tax Act. Section 92 to 92F has certain relevant provisions for TP, and Section 286 talks about the country by country reporting, which we will discuss in detail in coming modules. Then there are corresponding rules to these sections enacted in the Income Tax Rules 1962. By convention, we resort to the guidelines provided by the OECD and the UN for detailed guidance on application of TP principles and methodology to the extent the Act and the rules are not self-explanatory. Last but not the least and more important than the second part are the Indian judicial precedents. The courts have rendered several decisions on different aspects of dispute that today exist between taxpayers and tax authorities. These judgments also form a very key basis for understanding and interpreting certain provisions of TP regulations in India. Let's look at the broad contours of transfer pricing provisions in India, and for those of you who are interested, the respective section numbers. Section 92 to 92F codify the primary requirements of how TP regulations apply. The primary ingredients for it to be applicable are: there should be two or more enterprises. The absolute bare minimum requirement is that the transaction should be between two enterprises. If there is only one enterprise, then the provisions do not apply. Such enterprises have to be associated enterprise, and there is a definition provided for what associated enterprises are. Those enterprises should enter into a transaction. The transaction is defined under section 92F. Such transaction should qualify as an international transaction within the definition of section 92B. So, we will be going in detail into each of these aspects of definition in the coming modules. But it is very important to test for the existence of these four ingredients before we move forward with the applicability of TP. So the question therefore arises as to what happens if the four ingredients are present. The Act goes on to say that if the provisions were applicable, the taxpayer could compute its income or claim expenses for tax purposes basis arm's length price. Also, following compliance requirements are applicable. The taxpayer has to obtain a CA certificate in Form 3CB within a particular due date. He also is required to maintain detailed TP documentation as prescribed under Rule 10D within a particular date. Failure to do so may attract penal consequences. That brings us to the end of the first module, where we saw the concept of transfer pricing and why provisions are important and relevant. Like we discussed before, for the provisions to kick in, there has to be a minimum of two enterprises and they have to qualify as associated enterprises. In the next module, we will see what an enterprise is and when they become associated enterprise. We'll see you in the next module. Thank you so much for watching.